Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question for the topic non-current assets. In this question, you will learn to interpret the accumulated depreciation of assets account. You will also learn to find the correct depreciation method used and find the relevant depreciation rates. Lastly, we'll understand the differences between capital and revenue expenditures and understand the consequences of incorrectly treating these expenditures on the profits for the year. You can see the question on the left hand side of your screen, and on the right hand side we've got all the workings which I'll go through and explain to you step by step. So with that being said, let's begin. Sheldon owns Super Gym. To upgrade his gym facilities, Sheldon bought a new treadmill for $45,000 on 1 May 2019. And the business has a financial year ending on 30 April. So you can see we are given the ledger account for the accumulated depreciation of equipment, and it is given in the usual 5-column format that we're used to, with the date being in the first column, followed by the accounts which we cross-reference in the particulars column. Then we've got the columns for debits and credits, and lastly the net balance column. All right. Now, the first part of this question is to define the term depreciation. So when we think of depreciation, the simple definition is that this is the allocation of the cost of an asset over its useful life. But we want to think it from a different perspective as well. So depreciation expense is incurred in the consumption of economic benefits that help the business generate more revenue. So what do we understand by that? When you're running a business, every dollar that you invest it consciously in the sense that you would want the business to add more value to its marketplace and therefore generate more revenue. So obviously, if you're buying a non-current asset in your business, which in this case is a treadmill, and your business being a gym facility, what's happening is that treadmill will help you provide more value to your gym members and ultimately help you generate more revenue, right? So that is why as this treadmill gets used within the business, it is going to go through wear and tear. And that is the expense which we incur through the consumption of the economic benefits that originally came with this treadmill purchase, right? So therefore, you could simply write the allocation of the cost of an asset over its useful life and get full marks. But if you want to apply this from a real perspective, you can write also that this is the expense incurred in the consumption of economic benefits to help the business generate more revenue. And the example which I've just given you with regards to the treadmill being used in your gym and helping your gym members get more value, you could also think about it in that case. All right. So what about the part B? State the method used by Sheldon to depreciate his equipment. Now, when you look into the ledger account, simply at the end of the first financial year, which is 30 April 2020, given that the business started on 1 May 2019, you can see that we have recorded depreciation expense for the equipment to be $9,000, all right? And then when you move to the second financial year, which would have started on 1 May 2020 and ended on 30 April 2021, there is additional depreciation expense incurred of $7,200. Now, when you look into these numbers, you can clearly see that the depreciation expense is going down as we move from the first year to the second year. So once you have validated that, you can obviously conclude that we are using the reducing balance method, because the reducing balance, which is obvious with the name, is that we expect the asset to be depreciated at a higher amount in the earlier years of usage compared to the later years. All right. So once you can validate what's going on, then you could conclude with your answer simply. What about part C? Calculate the annual rate of depreciation applied. So here is where you can test again whether or not you're using the reducing balance method in this question. So let's do some workings to justify that. So starting with the first financial year, so we understand the treadmill was bought on 1 May 2019. So 1 May 2019 until the end of 30 April 2020, which is the first financial year, we want to capture the depreciation rate. So we already know the depreciation expense, which is given in the ledger account, to be $9,000 for the first financial year, and the original cost of this treadmill is $45,000. So the depreciation rate can simply be derived with dividing the depreciation expense by the original cost, and that is 20%. So whenever you're using the reducing balance method, you always want to find the net book value at the end of the financial period. The net book value at the end of the first year, which is at end of 30 April 2020, can be calculated as the difference between the cost and the accumulated depreciation. The cost is given to us at $45,000, and then the accumulated depreciation is the depreciation expense we have incurred in the first financial year, and that is $9,000, which gives us a net book value of $36,000 at 30 April 2020. Now, when we move to the second financial year, which started on 1 May 2020 and ended on 30 April 2021, the depreciation expense can now be derived by simply multiplying the depreciation rate of 20, which we have got for the first year, multiplied by the net book value of $36,000, which gives us $7,200. That also validates that we're using the reducing balance method, because this matches with whatever is given in the question for the ledger accounts, right? All right. And every time you use the reducing balance method, always remember to find the net book value at the end of the period, which in this case is to find the net book value at the end of year 2, which is at 30 April 2021. You could take the net book value that we originally had from the previous financial year of $36,000 and then subtract the additional depreciation expense of $7,200. That gives us the net book value at 30 April 2021 to be $28,800. And this is the requirement for Part D, where we are asked to find the net book value to be shown in the balance sheet or the statement of financial position as at 30 April 2021. All right, so you can see here in Part D. So the net book value at the end of 30 April 2021 is the net book value from the previous financial year minus the depreciation expense which we incurred in the second year. So $36,000 minus $7,200, and that is $28,800. All right. Okay, so now let's move to Part E. Explain what is meant by capital expenditure and revenue expenditure. So capital expenditure, as the name suggests, capital simply refers to the purchase of a non-current asset and then adding value to an existing non-current asset. So capital expenditure here is seen as kind of additional capital contribution to help the business become more efficient in what it is doing already. So when we buy a non-current asset, as we have discussed at the beginning of today's lesson, the purpose of having the non-current asset is to help us generate more revenue. And how do we do it? We consume the economic benefits that comes by default within the purchase of this non-current asset, right? And when we think of adding value to an existing non-current asset so that extra value helps us improve efficiency, that is also classified as a capital expenditure, okay? So you could think of buying a simple asset in this case. For instance, you could buy a motor vehicle, which is where you're purchasing a non-current asset. And then you are adding extra compartments within this vehicle so that it can be used in your business to help you generate more revenue. For example, let's say you run a food business and you want the motor vehicle to be fitted with equipment to help you deliver those items. So that is like adding value to an existing asset, which is the purchase of the motor vehicle itself, okay? So capital expenditure is simply when we buy a non-current asset and when we add value to an existing non-current asset. Revenue expenditure refers to the day-to-day operational expenditure of the business. This is basically the expenses that we incur in the process of earning revenue, okay? It could be your salary expense, wages expense, utilities expense such as electricity expense. You could have rent expense, repairs expense, many things that are just day-to-day in nature, and it's going to be there to help you generate more revenue, okay? So the simple way to look at revenue expenditure is to mainly think of expenses that the business incur, all right? What about Part F? State the effect on the profit for the year when revenue expenditure is wrongly treated as capital expenditure. So as we understand, revenue expenditure is simply expenses. Capital expenditure is simply increasing the value of your assets, right? So if we make a mistake by not correctly classifying the expenditures, what we are doing is that non-current assets will be overstated because obviously we have treated revenue expenditure as capital expenditure, like we are thinking that the asset value is going up. This could be a motor vehicle repairs expense, which you incorrectly added to the cost account of the motor vehicle. So you're essentially overstating your assets. And simultaneously, you're understating your expenses, which is the repairs expense that you have failed to record for your motor vehicle, but rather ended up incorrectly classifying it as part of the total cost and showing it in the assets. So the effect when the revenue expenditure is wrongly treated as a capital expenditure is that the non-current assets are overstated and simultaneously the expenses are understated. And we know profit is simply revenue minus expenses. So expenses are understated, profit will therefore be overstated, okay? So that's as simple as it can get. All right, so that's all for today's lesson. I hope you found value in this content. Make sure to drop a like and subscribe to this channel and share it with your friends. And I'll see you in the next lesson.